Okay, hi there, macroeconomics. In this video, we're going to take a quick look at the topical issue of corporate tax avoidance. Global multinationals like Starbucks, Amazon, Tutor2You and Google have faced intensive pressure for their perceived tax avoidance activities. This is obviously an important issue in the wider debate about the benefits and the costs of globalization. Transnational corporations are also known as TNCs. They've become obviously hugely significant in the world economy. The World Bank in 2016 found that 70 of the world's top 100 economies were actually corporations, measured by their turnover, by their size. Walmart, Apple and Shell, richer than Russia, Belgium and Sweden. Tutor2You, I think, is bigger than the Galapagos Islands. So the scale of tax avoidance, here is useful context if you want a little bit of evidence for an exam question. According to a paper by Gabriel Zuckerman published in 2018, firms in the United States booked, we'll come on to this, what this means in a second, they booked more profits in Ireland in 2018 than China, Japan, Germany, France and Mexico combined. So there's been a distinct shifting of the liability of tax towards low tax countries. The UK government estimates that about £6 billion worth of corporate tax avoidance happens in the UK every year. Think about the consequences of that for our budget deficit. The OECD, the group of advanced leading industrialized countries, the OECD estimates that between 4% and 10% of global corporate tax revenue, that's about, well over $1 billion, $100 billion, perhaps as much as $250 billion is lost each year due to tax avoidance. A lot of this revenue would have gone to governments in developing emerging countries. So corporate tax avoidance is a big issue if you get any kind of question on development barriers and trying to overcome them. There was a famous interview, a famous speech by the Dutch historian Rutger Bregman, speaking at Davos in 2019, a fantastic speech. Do check out Rutger's comments on YouTube if you get a chance. I hear people talking about the language of participation, of justice and equality and transparency, but almost no one raises the real issue, tax avoidance, and of the rich just not paying their fair share. What a quote. I mean, it feels like I'm at a firefighters conference and no one's allowed to speak about water. We can talk for a very long time about all those stupid philanthropic schemes. We can invite Bono once more. But come on, we've got to be talking about taxes. Taxes, taxes, taxes. All the rest is bullshit, in my opinion. Wow. Now, I wouldn't necessarily put that quote in the exam if you get the opportunity, but definitely worth mentioning this guy. His intervention in Davos was off the scale. So, a couple of slides just taking you through the idea of corporate tax avoidance. Big issue. First question, what is corporate tax avoidance? Well, essentially, it's anywhere where a company, a business finds a tax break, a tax allowance, a handy loophole that allows them to pay less in tax. This is actually very consistent with the concept of shareholder value theory, that the job of corporations fundamentally is to achieve a rate of return to those people who've invested in the company and taken the risk. So cutting the amount of tax paid on profits is fully consistent with shareholder value theory. Crucially, tax avoidance is within the law. There's a massive and entire industry globally of financial advisors whose job is tax law is to help businesses and wealthy individuals minimize their tax payments. The key question, the big one that you have to bring in, and of course there are value judgments all over the place on this topic, is tax avoidance ethical? Is it the right thing to do? There's certainly been a huge backlash against tax avoidance, particularly in an age of fiscal austerity with quite deep cutbacks in public services. Next question, how does corporate tax avoidance happen? How is it that lots of companies around the world are able to avoid paying tax? Well, there are different ways. I just want to, again, for the sake of revision, I just want to pick out really 4 ways. One is that basically businesses don't look to make too much profit. They reinvest the revenue they get to achieve fast growth. In a sense, they're growth maximizers rather than profit maximisers. Amazon is a great example, ploughing the money back into the business to grow their everything store and grow the size of their operations. If you go for revenue max and sales max, bit of micro, there's less pure supernormal profit to be taxed. The second point is fundamental, it's crucial, it's the idea of booking and transfer pricing. So much of a company's profit, if you're a transnational corporation, might well be earned in a foreign country, in an overseas market. While companies may book this in countries where the corporate tax rates are low. In other words, they basically assign payments, profits to countries where the rate of corporation tax is significantly lower. Businesses can also take advantage of tax credits, tax rebates for things like heavy research and development spending, investment in renewable energy, that kind of thing. And a lot of businesses now offer share ownership schemes to their employees, and often the cost of those share ownership schemes can be then used to offset against their corporate tax liability. Crucial to the whole debate is transfer pricing. Transfer pricing. Now, this is also known as profit shifting. I hope I said that right. And it happens when a transnational corporation moves the profits they've made from subsidiaries in a high tax country to other subsidiaries in a low tax country. So transfer pricing is basically when you have price divisions within a company. So Starbucks Ireland may charge Starbucks UK a fee, a royalty payment, if you like, for every cup of coffee sold in Starbucks UK, or it might charge Starbucks UK a management fee for using their brand or for using their advertising, what have you. Essentially, it's like an internal trade, a royalty for using a trademark, a charge for using Starbucks cups, whatever it is. Okay, this increases the profits for Starbucks Ireland, diminishes the profits for Starbucks UK, but in Ireland, corporation tax is 12%, contrasted with 18% in the UK. So basically, companies use transfer pricing to help them move their profits from high tax countries to low tax countries. That is legal. It is legal to do it. But of course, the question is it ethical? For many people, it's a game changer when it comes to transnational corporations' activities in the world economy. What can be done? Well, I just want to give you 2 or 3 ideas for revision for some of the policy reforms that might be implemented, some of which are already in place, others are being mooted, being suggested. One is something that the UK government has brought in. It's brought in something called the diverted profits tax. It's also known as the Google tax, 25% tax to company profits that have been diverted from the UK through complex transfer pricing arrangements. So that's already come in. In Germany, they've gone down the pathway of much tougher, stringent, transparent audit procedures. Those of you accountants will be getting very excited at this point. In Germany, they've gone for a much tougher accountancy audit regime to uncover some of the corporate activities, and they argue that actually they've collected over 64 billion euros in extra revenue from big multinational corporations over the last 5 years, a tidy sum. Other countries are going down the pathway of saying, well, if you go for tax evasion, if you use illegal tax evasion tactics, then executives, directors, shareholders can be personally liable. There's a thin dividing line between tax avoidance and tax evasion. And if you find evidence of tax evasion, the argument is you've got to ramp up the penalties, including personal liability for missing tax payments. 2 of the points, very interestingly, some governments are now trying to get international agreement to end this, if you want to call it, the race to the bottom on corporation tax. So some governments are saying, should there be, if you like, an agreed minimum percentage rate for corporation tax, so that all the advanced countries might have that minimum. That stops everybody head diving towards a 0 or 5% corporation tax. A minimum rate obviously would try to limit the amount of transfer pricing that goes on. Wider debate about whether there should be things like a Tobin tax on financial transactions, or should there be a specific digital service tax for those big multinational, transnational giants, Amazon, Apple, Facebook, Google, and who knows, businesses like Netflix going forward. That will be very hard to police, but it may well be the case in future years that countries will come to a mutually beneficial trade agreement on tax, if you like, to try and provide a level playing field to address this issue. Corporate tax avoidance is an issue that is well worth just having in the back of your mind. Any question on development, any question on globalization, this is a great topic that you can use. Thank you.